and we're delighted to have him today. He is our regional vice president from Lincoln Financial Group, and he heads the annuity division. And we have worked alongside Matt for a long, like I said, quite a long time, and he is absolutely phenomenal. His predecessor was a guy named Kevin Jones, and we just thought that he was irreplaceable until we got Matt, and so we got a nice surprise. And Matt brings a lot to the table. He knows this marketplace, and I know that you guys will glean some really, really good positive information from him, especially it being so timely with where we are now in the marketplace. So thank you, Matt, for doing this for us.
Yes, thank you so much, Angela. The partnership with you and all of GP Agency, I truly feel blessed to be able to be partnered with you and GP Agency. And I know I had big shoes to fill, so I really appreciate those kind words. So I really appreciate it. As Angela mentioned, my name, for those of you I haven't had the pleasure of working with, my name is Matt Wunderlich. I am the regional director for Lincoln Annuities in the Southeast. And first, just want to say a big thank you for you all taking the time to be here with us today. And I believe it's going to be time well spent, because I truly believe there has not been a better time to be positioning annuities for growth and accumulation than there is today. And that is where Lincoln and our Lincoln OptiBlend fixed indexed annuity is really differentiating ourselves from the pack, is being utilized as a growth and accumulation strategy. And the reason I'm so excited about positioning annuities for growth, specifically today, is probably no secret, right? We've seen extreme volatility in equity markets to kick off the year here in 2022. Just a few statistics to get the ball rolling. The S&P 500 is down over 16% year to date, about 16.6% year to date. And, not only is equity markets, highly volatile, is that common protected ways that we invest, common conservative ways that we invest, such as bonds and fixed income, are also being challenged in this current environment. As we find ourselves in this rising interest rate environment, that is negatively affecting bond prices and bond portfolios as well. So, the traditional 60-40 portfolio is off to one of its worst starts, or is off to the worst start, that we've seen in the history of markets, down over 11.6%. Clients want to hear about ways that they can invest their money safely. During these times of high volatility, clients want to hear about ways that they can grow their money without putting.
Oh. Matt, you froze. Matt, come back. What happened to Matt?
So as a bond alternative strategy. And then lastly, I want to talk about our Blackrock index inside of OptiBlend that is going to, offer international upside inside of the fixed indexed annuity as well. So to get the ball started here, I'm going to go ahead and attempt to share my screen, and we're going to talk about Lincoln's OptiBlend. And you'll see it is a flexible strategy for protected growth. That's where I want the Lincoln light bulb to go off in your head moving forward, is where should I talk about that Lincoln annuity? Whenever your client is asking about ways to grow their money safely, or wanting to take some risk off the table, whether it's out of their 401k or IRA, they're really concerned about this down and highly volatile market. That's where the Lincoln light bulb should go off, as the Lincoln OptiBlend is their strategy, a way to provide them what we call protected growth. And I truly believe, again, there couldn't be a better time to be talking about protected growth strategies than there are today in this highly volatile marketplace, and where common protected growth strategies such as bonds, are being challenged by this rising rate environment as well. So just a brief refresher on the Lincoln OptiBlend and the benefit of a fixed indexed annuity. What we like to say is that you don't have to sacrifice growth to enjoy protection, right? There are three key benefits to the OptiBlend fixed indexed annuity. First, foremost, and most importantly, is the power of downside protection, right? The OptiBlend fixed indexed annuity is a principal protected investment strategy, meaning that there is absolutely no potential for loss. The absolute worst performance you could have in a given contract year is 0%. So that's the big thing, right? Give investors the confidence during these times of high volatility to get off the sidelines and be invested. We can do that by offering outright principal protection. I also like to state that, offering principal protection is great. This is a safe money investment. It should be with a safe carrier. And it really doesn't get much safer than Lincoln Financial. We're an A+ rated carrier. We've been in the business for over 117 years. We've gone through the Great Depression. We've gone through the tech bubble of 2001, the financial crisis of 2008, the global pandemic that we still find ourselves in. And we've never been in stronger financial shape than we are today. So when you're talking to clients about safe money investing, make sure it's with a safe carrier. And that's where I like to lead with Lincoln Financial. A+ rated, 115-year history. So we know we can offer that downside protection, but the key thing is that we also can provide it with no fee, right? There is absolutely no cost associated with the OptiBlend fixed indexed annuity as well. So we're able to combat, two of the biggest hesitancies when it comes to clients, which is there's absolutely no risk and there's absolutely no fee. But at the end of the day, we're not investing to not lose any money, and we're not investing to not be charged any money. Those are great things to have, but at the end of the day, we're investing to grow our money. And that's exactly what OptiBlend brings to the table, is the upside growth potential we offer through several different indexing strategies. So just a few highlights on OptiBlend, just a few facts to keep in mind with OptiBlend is that it is a flexible premium contract. We do allow additional contributions into OptiBlend. They're limited to $25,000 per year or $100,000 throughout the life of the contract. So it's a very flexible contract, but continuing on with that flexibility is all the great options that we offer to provide that upside growth potential. You'll see that we offer 8 different strategies to grow that money inside of OptiBlend, including a fixed account. We have our Blackrock dynamic allocation, which I'll get into further along in the presentation. We have our Fidelity Index, our Daily Risk Control Spread Index, and our traditional S&P 500 allocation strategies. So now I want to talk about, 3, positioning or 3 areas where we've seen a lot of success positioning OptiBlend to clients. And I want to first start with the buzzword today, which is inflation, right? You can't have a conversation without inflation, inflation, inflation. The OptiBlend fixed indexed annuity can be a great inflation hedge for your clients. I'd like to share this stat here that you see on the screen, that we've never seen more money, more cash on the sidelines or money in money market accounts than we've seen today. Just under $5 trillion is sitting in cash or is sitting in market money accounts. So what does that mean, right? What does that mean to me? Well, it means that investors are hesitant, right? Investors are nervous, and there's a lot of reasons to be, right? There's a lot of volatility in equity markets. We have, global conflicts with Russia, Ukraine. We have the global pandemic that's happening. There's a lot of reasons to have uncertainty when it comes to markets. But when that cash is sitting on the sidelines, we know that we have to fight that fight against inflation each and every day. And if that cash is sitting on the sidelines, we're unfortunately losing that fight to inflation, right? The most recent CPI data that came out showed an 8.5% inflation rate, really the largest we've seen in the last 40 years. So a way to think about that is every day that cash is sitting on the sidelines, it's losing 8% year over year to inflation. So we need to find a way to give investors the confidence to get that money off of the sidelines and get it invested and fight that good fight against inflation. Taking the inflation conversation a step further, really drilling down to where we're feeling the pain of inflation, 2 big categories stick out. Energy is up 32% in terms of inflation, and cars are up over 35%. So while the headline CPI data is 8.5%, we're seeing larger inflation when it comes to food at 8.8%, energy at 32%, and transportation at 35%. So it's essential that we talk to our clients, our consumers, our investors about getting that cash to work and fighting that fight against inflation. Percentages are great, but I like to make it real. I like to really understand what we're talking about when it comes to inflation. And what this is assuming is a 5% inflation rate. So if you had $1,000 today, that means in just 5 years, that would only be worth $815. So, by showing these inflation statistics, everything I'm showing is fully client approved. I'll be sure to share with you all after the meeting here today. But by showing these statistics, hopefully we can give clients the urgency to get back invested and want to get that cash off the sidelines. But not just the urgency to combat inflation, but more importantly, we can give them the confidence to get invested again, right? And the way that we do that is through the principal protection of Lincoln's OptiBlend fixed indexed annuity. We can tell the clients that there's no risk and no fee, but we can put that money to work and fight that fight against inflation and provide great upside opportunities. So I want to talk about, some of the great strategies that we have inside of OptiBlend. So if you haven't seen, we had a great rate increase that went into effect yesterday on May 17th, 2022. A brief refresher on OptiBlend, we offer it in 3 different durations. We offer a short-term 5-year contract, a mid-term 7-year contract, and a longer duration 10-year contract. The number just represents the duration of the surrender schedule. So the 5-year contract is a 5-year surrender, 7-year contract is a 7-year surrender, and the 10-year contract is a 10-year surrender. When we talk about that cash on the sidelines, some key things that stick out to me where we've been having success is this fixed account of 3.5%. An incredibly attractive fixed account earning 3.5%. If the clients that you're working with, their thoughts on the markets are not, very great over the next year from all of this volatility, well, then we can offer them a great fixed account in year 1 of 3.5%. Where I see having success with this is as a MYGA alternative, right? We've really seen an increase in MYGA traditional fixed annuity business over the last 6 months, which is a great strategy, but it really limits you, right? It locks you into that fixed rate. And if that MYGA is only paying you 3.5%, 4%, we're still losing that fight against inflation. And I think it's important to keep not just the first year of the contract in mind, but years 2, year 4, year 5 in mind. And by Lincoln OptiBlend, I'll always come back to flexibility. We can offer a great fixed account of 3.5%, but then we can also offer the flexibility to reallocate into these different indexing strategies to take advantage of what markets do best, and that's recover, right? Our markets have a history of resiliency. Over the long run, they typically win. They typically recover from down markets. So right now, while we find ourselves in this highly volatile, down market scenario, we can take advantage of a great fixed account of 3.5%. But instead of pigeonholing ourselves and being forced into a fixed rate through a MYGA, by utilizing OptiBlend, we can offer more flexibility, and we can have the ability in year 2 of the contract to reallocate to a traditional S&P 500 account, our cap rate, which is as high as 7% right now, or into our S&P 500 participation rate, which is as high as 40%. So if right now we're not loving the upside of markets, we can utilize the great fixed account of 3.5%. But then in year 2, maybe markets are starting to recover. There's starting to be more positive news. We're seeing a boost in market performance. Well, at least you have the flexibility to reallocate out of that fixed account into a growth option, such as the S&P 500 cap or such as the S&P 500 participation rate. So I'm just going to pause there for one moment and just see if there's any questions, in regards to just some of those basic facts of OptiBlend or, some of the rate offerings that we're offering before I move on to part 2 of the presentation here today.
Let's see. I have a question here, and I'm going to have to mute people because we have a lot of background noise. But the question is, how long is the fixed account rate locked? Any minimums?
Yeah, absolutely. So great question. The fixed account and all the crediting strategies, that you see on the screen right now, those are the rates for the first year of the contract. So each contract anniversary would then have your renewal rates, right? So based off of the environment at the time, you would have, your renewal rates for contract year 2. So the fixed account of 3.5%, that's what is set for the first year of the contract. Then on your anniversary, it would be subject to renewal rates. So it is, there is the potential for it to change, to possibly decrease. But that's where I come back to highlighting Lincoln's financial strength. We are an A+ rated carrier. We have 115 years in the business. We are not the type of carrier that, puts great new issue rates out there and then, have tough renewal rates. We are big believers in our renewal rates. That's what I just brought on the screen here, that since we created OptiBlend back in June of 2015, the average renewal rates were within 90% of the initial declared rate. So we certainly have a history of strong renewals, but to be crystal clear, the rate is only guaranteed for the first year, and then on that next anniversary, you would have those renewal rates.
Oh, Matt, you're frozen again.
Can you hear me okay?
Yeah, you were frozen there temporarily.
Okay, I'm here. I hope that answers the questions. I didn't know if there was any additional questions or any further details needed on that.
I think we're good.
Okay, fantastic. So, we talked about the inflation hedge opportunity, right? We're fighting that fight against inflation. We can give both clients the urgency to get back invested to combat inflation, but then more importantly, the confidence to get invested through the principal protection of the OptiBlend fixed indexed annuity. The second key opportunity that I wanted to discuss here today is utilizing the OptiBlend annuity as a bond alternative strategy. So for those,
oh, okay.
Yes.
I'm sorry. I just, Angela asked about if you could talk about the participation rate.
Yeah, absolutely. So, inside of OptiBlend, we offer a lot of different strategies. Angela, I see you in the chat. Yeah, absolutely. I'm going to finish today's presentation with that Blackrock index. So I will absolutely get into that for you here today. So moving on to opportunity number 2. Positioning the OptiBlend as a bond alternative strategy. This is something we've been talking for quite a while at Lincoln, and we're calling it the fixed income dilemma. We truly believe that it is a tough spot for bond investors right now. So for clients with 401ks or IRAs that are approaching retirement, we know we have that traditional allocation of 60-40, right? 60 equities, 40 fixed income. And we used to be able to rely on that 40% fixed income to be our safe asset and to provide a little bit of a growth boost to the overall portfolio. But the reality, that was a great strategy for the last 30 years where we were in a bond bull market and interest rates were doing nothing but decline. But we have to keep in mind that inverse relationship between interest rates and bond prices, right? As interest rates rise, bond prices fall. Well, there's no denying the fact that we are currently in a rising interest rate environment, right? The Fed, getting back to that buzzword inflation, has already, done 2 rate hikes this year of 50 basis points, and we're anticipating another 4 rate hikes this year. So that inverse relationship of rising rates has a negative effect on those bonds. A key statistic is the S&P 500 is negative 16% year to date. But did you know that the U.S. aggregate core bond index, that core bonds are negative 10% year to date? Double-digit losses in what is meant to be the conservative asset class for our clients and our retirees. And that's the fixed income dilemma that we've been discussing. There's 3 key components to this fixed income dilemma: the shrinking yield cushion, rising rate risk, and lower future returns. So let's talk about the shrinking yield cushion. That's really just a fancy way of saying that we're not seeing the yield on bonds that we're accustomed to, right? Back in the 90s and 2000s, we were seeing bond yields of 7 to 8%, which were great for that 60-40 portfolio. But over the last few years, the yield on bonds has been sub 3%. It was only 1% in 2020, and currently, year to date, only 2.9%. Well, I believe that we can offer more upside potential than 2.9% in OptiBlend, versus what we're seeing in bonds. But another key thing to note is that bonds have been a big double win over the last, 10 to 30 years. You were getting good starting yield in bonds, but you were simultaneously getting capital growth from a falling interest rate environment, right? Over the last decade, interest rates have done nothing but decline, which meant bond prices have gone up. So you were getting good starting yield and you were getting capital appreciation from a falling rate environment. Well, that double win today looks a lot more like a double whammy because we're not getting the starting yield. It's sub 3%. And as discussed, we're in a rising rate environment, which is resulting in capital depreciation to those bond prices. Again, the core bond index is negative 10% year to date. So that leads me to the second big risk of bonds, which is rising interest rate risk. And it's what we discussed, right? As interest rates rise, bond prices fall, which is creating a big challenge, to that conservative portion of clients' retirement portfolios. The last thing I'll note is what can we expect from future bond returns? What we did at Lincoln was we compared the starting yield of the bond to what the bond earned over its duration, over 10 years. And we found that the correlation is 97%. It's essentially identical, right? So what does that mean? It means that whatever the starting yield of your bond is essentially what you will earn over the life of that bond. Well, if the current yield is only 2.9%, do we think that we can outperform that? Do we think that we can provide more upside growth potential than 2.9%? I'm confident that we can. And of course, we can do it through OptiBlend's fixed indexed annuity, right? First and foremost, it's safer than bonds, which are negative 10% year to date, because the worst you can do in OptiBlend is zero. We know we can't lose, but we're going to provide more upside growth potential than we're currently seeing in bonds. So as a bond alternative, I want to focus on one of our differentiators here, which is our daily risk control spread allocation. Now, whenever I talk about using an annuity for growth, I always talk about the two P's, pricing and performance. Pricing and performance. If you take anything away from me today, write down those two P's, pricing and performance. You have to have both of them to have growth inside of an annuity. So let's talk about the pricing of this account. This account utilizes a spread rate. For those not familiar with a spread rate, the way it works is that at the end of the year, we'll calculate the percentage change of the index. And if that change is positive, then we simply subtract the spread. So what makes that pricing attractive is the uncapped upside that it provides, right? There is no limit to what the index can return. No matter what the index returns, we just simply subtract that spread. Now, so we have great uncapped pricing. Now, the cherry on top is that we're offering the lowest spread rate that we've ever offered. It's only 0.25%, 0.25%. So we check that first box for pricing. We offer uncapped upside on the pricing and an incredibly low spread rate of 25 basis points. But pricing doesn't mean anything if you don't have performance, right? It's great that I offer you uncapped upside, but if the index it's tied to only performs 1 or 2%, that uncapped upside doesn't do you any good. Well, at Lincoln, we offer great pricing, but we also back it up with performance. So what you're seeing here is our client flyer on this daily risk control index. And a few highlights that I want to talk about on this index is that first and foremost, the index does not include bonds, right? We're talking about using this as a bond alternative. This is a true bond alternative strategy. There are no bonds in this index. It does include dividends. So you do get the power of total return and dividend reinvesting. So I want to go through an example of an OptiBlend 5 contract over the last 5 years. This index was created back in 2009. So the performance figures that you're seeing here are real historical performance, right? It's not back tested. This is what actually happened in this index. So if we look back over the last 5 years, in 2017, the index returned 14.97%. Remember, uncapped upside, we just subtract the spread, which means clients earned over 14.7% in 2017. That's the home run potential, right? That's the power of uncapped pricing. In 2018, the index was negative. If you remember 2018, the markets were negative. We had that really rough fourth quarter, specifically Christmas Eve. So we had a negative year in 2018, but we know in OptiBlend, the worst we can do is zero. Zero is our hero, so we take a zero in 2018. In 2019, the index returned 10.21%. Uncapped upside, subtract the spread, clients earned almost 10%, right? About 9.96% in 2019. Almost 10% credit in a no-fee principal protected product. In 2020, amidst all the volatility of the COVID pandemic and the elections, the index had a small return of 1%, so a small credit of about 0.76. But then it bounced back great last year in 2019, returning over 9.29%, over a 9% credit in 2021. So at the end of the day, if you look at how the index has performed over the last 5 years, and you apply that 0.25% spread, the average annual return of this daily risk control index over the last 5 years was 6.9%. 6.9%. So my question is simple. Where else can you go in today's interest rate environment to have the opportunity to earn over 6% a year with absolutely no risk and absolutely no fee? So that has definitely been a big success for us. A key differentiator is utilizing this daily risk control index, as a bond alternative strategy. So we opened up the conversation about using OptiBlend as an inflation hedge and how we can give clients both the urgency and confidence to get off the sidelines and invested. We just talked about some of the challenges that bonds and fixed income are facing and how we can utilize this daily risk control index as a bond alternative strategy. Before I move into the final part of today's presentation and talk about the international upside of that Blackrock index, I do want to pause again and just see if there's any questions, any thoughts around this daily risk control index or the bond alternative opportunity out there.
Didn't see any. Yeah, nothing's coming up.
Okay, great. So let's move on to part 3. And what we want to talk about here is, the last opportunity I want to discuss is the opportunity that we see in international markets right now at Lincoln. And the way that we can bring the upside opportunity of international markets to clients is through our Blackrock Dynamic Allocation Index inside of our OptiBlend fixed indexed annuities. So this is a great opportunity to help clients diversify, give some international exposure, as well as hedge against inflation, right? That buzzword again. So this is what really jumps out to me. Leaders rotate. Is it time for international stocks to shine? So what you're seeing on the screen here is a comparison of US stocks versus international stocks over the last 40 years. You'll see that in the 1980s, international stocks outperformed. In the 90s, US outperformed. In the 2000s, international outperformed. Over the last decade, we know that US has outperformed. We've had a great bull market run in the S&P and US stocks. Well, listen, I admit I am no international market expert, and I will never pretend to be. But I think even I'm capable of completing the pattern on the screen here, right? We've seen these international versus US flip-flop decade by decade. And a lot of leading asset managers believe it's time for international to shine, and that international stocks provide, are providing a lot of upside growth opportunity and are set to outperform in the 2020s over the next decade ahead. Continuing on with that, the current outperformance of US equities is the longest it's ever been, and it may be a bit long in the tooth. So what you're seeing on the screen now in light blue are the times in which US stocks outperformed, and in dark blue is times where international outperformed. And you'll see that on average, the average outperformance was about 20 quarters or so, about 5 years. Well, the current outperformance of US stocks has been 44 quarters, the longest by 75%. Again, kind of leading to that thought of, is it time for international to shine, right? We know that markets move in cycles. It looks like that this bull run of US equities, is a bit long in the tooth, and we think that that creates a great opportunity for international to shine in the decade ahead. So let's get down to it, right? One of the big advantages we have at Lincoln is being partnered with leading asset managers such as Blackrock, State Street Global, and JP Morgan. You'll see that all of these leading asset managers are forecasting international equities to outperform US equities over the next decade ahead, an average outperformance of 7.2% versus 5.8%. So here's my question to you, and here's a question that you can ask your clients. How are you diversifying your portfolio, your retirement, for international upside, right? How are you taking advantage of international upside inside of your investments? Well, if you're not currently taking advantage of international upside, let me show you a great way that you can do it through Lincoln's OptiBlend fixed indexed annuity, right? I like to first start again with you can't lose. So what better way to offer clients the upside of international markets than through the principal protection of the OptiBlend fixed indexed annuity? Secondly, going back to those two P's, right? Pricing and performance. We offer tremendous pricing on our Blackrock index. This index allocates to both international and emerging markets. This is our global option. We offer phenomenal pricing, a 1-year participation rate as high as 155%, and a 2-year participation rate as high as 200%. So if you're not currently diversifying for international upside, I think there's a phenomenal opportunity to do so through Lincoln's OptiBlend fixed indexed annuity and our Blackrock dynamic allocation index. So let me bring this all together. We talked about, 3 key opportunities here today. We talked about positioning the OptiBlend as an inflation hedge. We see a lot of cash on the sidelines right now. There's a lot of hesitancy from investors. Through the principal protection and upside potential of Lincoln OptiBlend, we can give clients the confidence to get that money off the sidelines, get it to work, and combat inflation. The second big opportunity we discussed was the bond market. We're seeing a lot of assets flee the bond market right now in this rising rate environment. It's a very tough spot for bond investors right now. Through the Lincoln OptiBlend, we can provide a safer option with outright principal protection and simultaneously provide more upside growth potential than we're seeing in bonds and fixed income. And then lastly, I talked about international markets. We believe that there is a big opportunity when it comes to international markets right now. The last thing I'll share with you is from Blackrock's capital market assumptions. This is a public access website. You can just Google Blackrock capital market assumptions and see their forecasts over the next decade ahead. And you'll see that their equity forecasts, they have all global and international projected to outperform. Emerging large cap equities, Europe large cap equities, and global large cap equities are all forecasted at around 8, 9, 10% over the next decade. versus 6-7% of US large cap. But at the end of the day, I always like to preach diversification, right? Investing 101, don't put all your eggs in one basket. And that's where OptiBlend really differentiates itself, is the tremendous flexibility we can provide. We can provide US market upside with our S&P 500 accounts and our daily risk control spread account. We can provide international upside with our Blackrock dynamic allocation account. So I really love a mixture of Blackrock and our S&P accounts to give clients both diversification and also the upside to US markets as well as international markets, of course, with outright principal protection. So Angela, everybody over at GP Agency, I can't thank you enough for your partnership.
Matt,
yeah.
I do have a couple questions.
Oh, of course. And I was just going to say thank you for everybody's time, and I'd be happy to open it up to questions now. Yeah,
okay.
Absolutely.
Okay, so we have a question here. Do either the S&P 500 index options also include dividends, not the 5% risk control index?
Yes, they are total return. Correct. So all the indexes are total returns and include dividends.
All right. And we had another one here. Just a second. Where'd it go? Where'd it go? A chat. I don't see it now. No, we got something else up here. Okay, Joan. Oh, what is the maximum age limit for this annuity?
It is age 85. So the max age is age 85. That is on our OptiBlend 5 and 7. So OptiBlend 5 and 7 does allow issue up to age 85 or up to age 86, meaning you can be age 85 and 350 days old, just cannot be 86. The OptiBlend 10 max issue age is age 80. So 85 for the 5 and 7 year, age 80 for the 10 year.
Okay, one more question. If you split the Blackrock and S&P, is the Blackrock fee only on the portion allocated to the Blackrock component?
Yes. So that is something, you know, in the interest of time, that I did not discuss here today. But you will see we offer 3 different ways that you can allocate to our Blackrock index. We offer a traditional 1-year allocation with a participation rate. This is no fee, you know, 1-year participation rate of 155%. We also offer a 2-year, which has a participation rate of 200%. We have recently introduced our 1-year Blackrock Plus account, and you'll see the star that this does include a fee. What this is our new pay for rate strategy, meaning it is a 1% fee. But if you want to pay a 1% fee, we can boost the participation rate for you, currently 200%. So the OptiBlend is a no fee contract as long as you do not allocate to the Blackrock Plus. To answer the question, only the money allocated to the Blackrock Plus account is charged the fee. So for simple math, if you invested $100,000 and you put $100,000 into the S&P daily risk, or $50,000 into the daily risk control, and the other half, $50,000 into the Blackrock, the 1% fee would only be assessed off of the $50,000 that is allocated to the Blackrock Plus. Essentially, it makes it a 0.5% fee, right? Because we're only charging 1% on half of the money. I hope that was clear.
Oh, let's see. A couple more here popped in. I have a question. Can you please? Oh, yes, I can unmute you. Okay. And Michael said that answered the question. Just give me a moment here. I got to unmute somebody. Oh, where we go. Sorry. In the meantime, another question, what type of assets should we be looking for in a 1035?
Yeah, absolutely. So while we wait for Todd to get unmuted, I'd be happy to address Michael's question. So, Michael, 1035 exchanges, those are, of existing annuity contracts or, cash value of life insurance. Where I can tell you I've seen success is, there was a lot of annuities that were sold with income riders over the last 10 to 20 years. And clients today may no longer need that asset for income. So what that means is that clients may have an annuity contract that they're paying a fee for the income rider, and they're never going to use that income guarantee. I call it the gym membership annuity, meaning that every month I have $30 come out of my account for my gym membership. But unfortunately, I don't use the gym enough. So I'm paying for something that I'm not using. Where we've had success is clients who have these income riders, which at the point of sale, when they purchased it 5, 7, 10 years ago, was certainly probably the right thing for them. But we know that things change, right? 10 years later, 10 years ago, you thought you needed income off of this asset, but 10 years later, you no longer do. Well, that's a great opportunity to 1035 exchange that annuity contract to Lincoln, and we will, we're going to reduce the fee. We're going to go from paying a fee on the income rider to paying no fee in OptiBlend and repurposing the asset for what it's really designed to do now, new point of sale suitability, which is upside growth potential and accumulation. So we've had a lot of success replacing older annuity contracts with income riders where the client does not need the income anymore.
Okay, and Todd, you're free to.
Hello, Matt.
Yeah, hey, Todd.
Hey there. Thanks for taking my question. It was going to be too hard to type. I wrote a fixed indexed annuity with Lincoln on a gentleman 3 or 4 years ago. On his annual statement, the market value, because of interest rates going so low, is market value adjustment and such, that he was able to not only take all the money he put in plus the account value, but even more, so maybe 5% more, and it just wiped out the surrender charges. But we didn't have anywhere to put it. Didn't know where to go with it.
Right.
Now, since he's in that particular account, is the Blackrock available to those older accounts, or what would be available to him? Because I think the market value adjustment has changed where, he's not able to get out of that product without paying a surrender charge. But what are his options?
Yeah, absolutely. So Todd, I would be happy to schedule time, one-on-one with you. I can tell you the Blackrock would not be available on that contract. It's only available for contracts, issued today. But if you want to, schedule, a time individually for you or I, if you could just provide me that contract number, I'd be happy to do some due diligence on that contract, see the different allocation options and pricing that is being offered to that client. And we could set up a time to discuss, a potential reallocation on the next contract anniversary.
Yeah, yeah, that's fine. He's not unhappy at all. I was just wondering if that option was available.
Yeah, it is not. The options that would be available to that client would be the options that were available to him, when we wrote the application.
Gotcha. Now, I wrote my first index annuity early 2000s. Angela held my hand through it. It was the Opti Point, which is kind of a cousin to this, but have been really pleased. But throughout the duration where interest rates were high and then low, we went through that low period. This product illustrates so well. It's almost scary, and my enthusiasm might even scare clients because, it just sounds too good to be true. Have you? This is not an objection, mind you. I just wondered, I've never seen anything illustrate like this.
Yeah, Todd, it's where I opened up the call today. I mean, I truly believe there has never been a better time to be positioning an annuity for growth than there is today. And the reason is that, the way that clients have invested in the past, right? U.S. equity investments, it's been a very volatile year, and markets are down 16%, and clients want protection. We can provide that. Bonds and fixed income, that's how we typically offered protection. But in this rising rate environment, that's putting a lot of stress and challenge on bonds. So, the reality is, the perfect storm for annuities for accumulation is when equity markets are volatile and interest rates are on the rise. And that's the exact environment that we see ourselves in today. So I'm like you, Todd, I can't talk to enough people about the incredible opportunity we have in using OptiBlend for growth and accumulation. I would say it's not too good to be true. The only thing to keep in mind is the surrender schedule, right? You do have either a 5, 7, or 10-year surrender schedule. So you want to be investing assets that you don't anticipate needing, but you also do have your 10% free withdrawal. So the contract does offer 10% free withdrawals on day one, so you can access some of the money. But I'm right there with you, Todd. I mean, the pricing has never been stronger. Clients want to hear about ways to grow their money safely. There's really no better option out there. You're not going to get the upside that you're seeing in OptiBlend from a bank investment like a CD. You're certainly not seeing it in bonds and fixed income like discussed. So, just a tremendous opportunity to be positioning the annuity for growth right now.
Well, where I see the value in this is where you have these brokerage accounts, they're already paying a fee on their money market, their bonds. And so in the event if they were to get a minimal return, they still got to pay a fee on that. Whereas if they put it over here, their money is 100% guaranteed safe. And I'm the 1% fee guy. I want that plus. I mean, that just performs phenomenally. And then, move their safe money over here. It gives them an opportunity, like say if they're taking distributions and the market's down, they're not forced to sell their accounts low. They can pull it from this in the meantime. Hopefully they're enough to satisfy the distributions, but then they get familiar with this and maybe move a larger part of their money over. Anyway, so I'm just really excited about this opportunity, more excited about an indexed annuity than I've ever been in 2 decades.
I really appreciate that, Todd, and I could not agree with you more. Just want to, I see some other questions coming in.
We do have some other questions.
I won't monopolize. Sorry. Thank you.
No, absolutely. I really appreciate that, Todd. Thank you. So I think I'm seeing the questions here. So just let me know if I missed anything.
Okay, let's start with Joan. Yeah.
Yeah. So Joan asked about RMDs. The annuity is RMD friendly. Yes. And you can take RMDs right away. So, we can set up those systematic RMD contributions, as soon as the contract issues. So it is an RMD friendly contract, and you can absolutely take RMDs from the Lincoln OptiBlend.
And then we've got Todd, another Todd.
Yeah, absolutely. So I believe he's asking about the surrender charge schedule. So I'll go ahead and share my screen again. I apologize if it is a little small. I will make it bigger. You'll see the corresponding surrender schedules on the far right side of the rate sheet. So let me see if I can scroll over to them just to make them large enough for everybody.
Here we go.
So you'll see the 5-year surrender is a rolling surrender of 9% in year 1, and then it goes 8, 7, 6, 5, and they're all very similar to that. It starts at a 9%, and it's a rolling surrender that decreases until the end of that surrender schedule.
Okay. And one more question. Whoop.
The minimum deposit is $10,000.
Okay. The question here is, are you going to talk more about the 5% risk control?
I'd be happy to. Is there any specific questions that I can address on that daily risk control index?
And Howard, I can give you the option to elaborate.
So I saw there was a question on the minimum deposit is $10,000 and the penalty-free withdrawal is 10%. So the contract allows for a 10% penalty-free withdrawal each contract year.
Okay.
That 10% free withdrawal is available day 1. There is no waiting period, which is another big differentiator for us. And I know that it's not about this, but I will just, address the question. That 10% free withdrawal does not result in a commission chargeback either. As long as the withdrawal is within the penalty-free amount, there is no commission charge back. I saw that there were some questions on commissions. I would pass that back to, I don't know, you can reach out to Angela or myself after this call. We offer 3 different commission options, either a full upfront commission, some upfront with a trail, and then a little bit upfront with a larger trail. So we do have flexibility in the different commission options that we offer.
Okay. And did we address, let's see, are you going to talk about the, a general question about the 5% risk control? He just said general information on that.
Sure. So I can do another quick refresher on the daily risk control index. I'd love to. It's certainly one of our big differentiators. So, what I want to be clear about is that this is a volatility controlled version of the S&P 500. So I believe the question is kind of how does the index work? Well, it's really quite simple. The index is made up of 2 components. The equity portion is the S&P 500, which is shown in red. It then has cash that is used to manage the volatility of the index and meet the 5% volatility target. So it's just a mixture of S&P 500 and cash. And the mixture between the two depends on the volatility of the marketplace. So if volatility increases, right, if we see volatility as high as 15, 20%, well, that means we have to increase the cash weight. The cash weight increases to manage the volatility back to the target of 5%. On the other side, if volatility is low or volatility decreases, that's when we can increase the S&P 500 exposure and the cash weight decreases. So the index is a mixture of S&P 500 and cash. The mixture between the two fluctuates based off of the realized volatility of the marketplace.
Okay. And then question here from Michael, is it a fair way and compliant to say that the cost of the FIA, aside from the Blackrock fee, is only a potential opportunity cost versus equities in significantly up years?
Absolutely, Michael. I think that that's a great way to describe the no fee nature of the fixed indexed annuity, right? There is no explicit product charge, but I think that that is above and beyond transparent by you to the client in stating that, there's no explicit product charge outside of the BlackRock Plus account. There's no fee that's going to come out of the contract. The only cost that you could say there is the potential opportunity cost, right? If you are utilizing the S&P 500 cap rate of 7% and the S&P returned 10%, well, then you would have gotten 7 in the Lincoln contract. You would have been capped at 7%. So I think that is extremely well put and absolutely fair.
Okay, let's see. One more question here. You mentioned a no fee, so the first year commission is not subtracted from the client's deposit, correct?
Absolutely not. Lincoln is paying you, the agent, the advisor, the financial professional, a commission for bringing the business to Lincoln. It is not coming out of the client's account at all.
Okay. I think we're good. We almost took up that entire hour. This is
I can't tell you how much I appreciate the engagement. Thank you all so much for the questions. It really makes it a lot easier, especially over this Zoom virtual world that we find ourselves in. So again, I can't thank you all enough for your time, for your engagement. If there's anything that I can do to support you, support your annuity business, please don't hesitate to reach out. And I wish you all a great rest of your afternoon.
And do you have a client piece that maybe
absolutely. Would it be okay if I emailed it to you?
You email it to me and I'll share it. Yeah.
To send to the attendees? Perfect. Thank you.
Yeah.
Yep. I will send this information over to you.
Okay, great. Well, appreciate it.
Absolutely. Thank you, everybody. Have a great rest of your afternoon.
You too. Bye.